Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome to Real Estate 360 program, your number one source for all of your real estate needs here in the Bay Area, where we provide you with the information you need to make the best fact-based decisions. Welcome back. Want to remind you that Real Estate 360 is on 5 days a week, Monday through Friday at 3 p.m. I get to co-host with Joe Kuchera and Lori Graymont. And Joe's on Monday and Tuesday and Friday, and Lori's on Thursday. And we're glad to bring you all the aspects that we can of real estate, buying, selling, loans, investing. I'm Tom Wilson. I host the Wednesday edition, and we focus on investing. I'd like to just let you know that I'm not an attorney or CPA or a broker. I'm just an investor. But I've had about 37 years of experience buying and selling a couple thousand units. And so what I share with you will be the experience I have from that. And I'm just glad to help anyone who's starting off with real estate investing to maximize their success and shorten their path to getting success. We have, in addition to our own personal portfolio, we have a company called Wilson Investment Properties, Inc. that provides turnkey quality investment properties to other investors. Today we're going to cover frequently asked questions from our listeners, and we're going to walk through a number of those that I think will be of great interest to you. And next week we will have with us Richard Crouch. Richard Crouch is a veteran Silicon Valley high-tech entrepreneur and top-producing award-winning real estate agent for Lon Pennell. Richard was with several high-tech companies and was a founder of one of them. He's used his high-tech background to track the market, and will be sharing his insights and what's happening in this exciting market that we're in and where he feels things are going and why. So don't miss that one next week, 3 p.m. here on KDOW. And if you missed that time and want to listen to the programs at your convenience, please go to tomwilsonproperties.com. And on that website, there will be a list of the podcast and the topics, so you can pick the one that you want. Also, while you're there, you can sign up for a weekly newsletter, which is a nice 1-minute read, one page on the screen, that will give you what's happening in real estate from an economics perspective. So it's a great summary of what's the highlights have been for the past week in real estate around the Bay Area, and around the country. Also, there is a 19-page report on how to choose the best metro and property. So if you ask for that, we're glad to send that to you. And we welcome your questions. You have a personal question, you have a general question you want to hear on the air, we're glad to give you our input. And if we don't know the answer, we'll get you in touch with someone who can, indeed. So let's get into our program for today and cover a lot of the questions that investors have out there about real estate. And they're all great questions. We've never had a question that we didn't think was warranted. There's no such thing as a bad question. And this is a very exciting, dynamic time. And it's kind of feels like, if you look at the headlines, maybe you want to throw a dart and jump in there again and grab anything. But please don't do that. Get yourself educated. Don't be a multi-year student and never buy anything, but make sure you get your information from more than one source and get yourself educated so you can make good, intelligent decisions. So Daniel Chang says, Tom, can you explain to me what the different types of real estate are that I can consider investing in? Certainly, David, there are many who ask that same question. One of the problems is that you will hear people promoting some pretty big projects, suggesting that you be a partner in a large project, and that by doing so it reduces the risk. Some people have had success with that. I would say that in general, I personally prefer projects that I get to control what's happening to it, or if it's with a partnership or syndication, that it's a very short-term project. But I think there are a couple different approaches you can take. One would be actively involved that produces income now from your being involved in it, such as flipping, or long-term holds that would produce passive income with time. And I think the latter is the first priority unless you don't have any money to start with. But if you have some money to start with, and especially if you have a day job or don't want to be involved, start accumulating assets and real estate that produce income. You can do that in single-family homes, duplexes, triplexes, fourplexes. That's referred to in real estate lingo as 1-to-4s. And they have their own unique kind of loans, and those are loans that are often sold to the federally backed and guaranteed lenders, so such as FHA, Fannie Mae, Freddie Mac, and they all are supporting, or they support residential loans, and residential's referred to as 1-to-4s. When you get more than 4 units in a property, it's referred to as multifamily. And multifamily has a totally different lender set of sources, and that starts to get much more sophisticated and many more gates to go through to make sure you make a good decision. There's then commercial, which are properties which are not for residential and are not multifam, and those are your office spaces, R&D space, storage units, manufacturing, etc. Those are for the big league after you have a lot of experience. And even multifam, I have people come to me frequently and say, Tom, well, I have good credit and I have fair amount of cash. Maybe they've accumulated $500,000, million, even $2 million in a 401 or other means. And they say, I think I'd like to buy an apartment house. So first thing I have to tell them is that unless they currently own an apartment house, or multifam as it's referred to, and or have had a lot of experience in the multifam arena, the chances of getting a loan, certainly one that's backed by government, is virtually zero. Money's very tight in that arena as well, not just 1-to-4 residential, and it's very difficult. Plus, you're putting a lot of eggs in one address and a kind of investment that you don't have experience with. It's a lot more complex managing and owning a multifam or commercial property than it might appear on the surface. I've had 7 and been involved in others, and it's not that easy to predict how they're going to perform. It's much easier to predict how a single-family home or even a 2-to-4 is going to perform. So I would suggest not starting there. Once you accumulate a lot of 1-to-4s or single-family, then sometime in the future, maybe one of those is in your future. But a multifamily property, I find, has the highest probability of success when it is large enough to afford a full-time on-site property manager and a full-time on-site maintenance. The on-site property manager allows one to control the tenants and the environment much better. If you have distributed homes, if you have one bad tenant, it doesn't affect the others. But if you have a multifam property and you get a bad tenant or two, and especially if no one is present on a daily basis, then that bad apple can spread very, very rapidly to your other tenants. your property manager shows up in 2 weeks to show a unit, and they find suddenly that 6 people out of 16 have moved out. And this happens all the time. So, and in most cities in the country, to get a property that has enough income to afford full-time on-site manager, you're looking at something like $2.5 million, which means for a down payment, you're looking at least $700 to $1 million in down payment, and that's if you haven't been an investor yet or only had a few 1-to-4s, that's a big leap, and I don't recommend it. How about houses versus 2-to-4s? Well, in a normal world, in normal markets, whatever that used to be, if everything else is equal, the more units per building you have, you would tend to get a little bit higher potential income. Not a lot, but a little bit. And in the old school, as you would start to accumulate properties, most investors would start to buy more duplexes, then fourplexes, then small apartment houses, and so forth. But in the market that we're in, and have been past several years, I find that most well-chosen houses will perform as well, after all is said and done, as a 2-to-4 duplex, triplex, fourplex. And when that's the case, I generally prefer a single-family home because they're simpler. The prices are driven by the owner-occupant demand, and they therefore tend to appreciate more than a 2-to-4 does. Income property is driven almost exclusively by how much the rents are increased, not by how much the demand goes up for that particular kind of product. So they are more liquid. If you need to sell or want to sell, you can get out of it quicker because you have the whole owner-occupant market, not just investor market to sell to. It's easier to get loans. You can get loans more quickly and faster, and it's just a lot easier to manage and to keep it simple. And again, you don't put as many eggs in one address. So I really prefer in this marketplace single-family homes. And I think out of all the different kinds of real estate, if you just have a few or starting, stick to that, accumulate a portfolio of them, and they will do very well for you if they're well chosen. So we're on AM 1220 KDOW. We will continue with more questions here in just a moment. And after these couple of messages, we'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360. I'm Tom Wilson, and we are talking, we're giving answers to our listeners' questions about investing in real estate. And remember, next week, please join us when Richard Crouch is here from Milan Pinnell Realtors, who's an entrepreneur and high-tech turned real estate agent, and he has a very good insight as to what's going on in our hot marketplace and where things are headed. Our next question we have from Quinn Wong is, when is the best time to buy real estate? So that's certainly a fair question. And the first thing I'll say is that one must recognize that we don't have a real estate market. We have thousands of real estate markets just in this country alone. And indeed, they vary a tremendous amount. Amazing how much they differ from one area to another, from one price range in the same area to another. So be careful about generalizations. When you consider investing in something, in a property, make sure you learn as much as you can about that neighborhood, about that street, not just that city. It varies a tremendous amount. So you have to be very careful about the submarkets. So the best time, of course, to buy anything in the way of investment is when it's about to go up or going up versus coming down, but you, of course, can make money in any market if it's a downward trend, if you can pick up a property that is on its way down, but you can get it at a price that it hasn't reached yet and get out before it's reached that point, you can still do okay. But that, of course, is quite risky, and unfortunately, many people across the country, including myself, did not get out of some real estate when they would have been ideal. Fortunately, I was invested predominantly in a city, Dallas-Fort Worth, that had the lowest decline of any metro in the United States. So my holdings there declined very little compared to those, unfortunately, that were in more glamour cities at the time. It took a big hit. So the best time to buy is when it's going up, or at least not going down. But in order to determine that, you've got to get an expert that knows that region extremely well. Do your research online, but even with the experience that I have, if I were going to invest in a different city, pick a new city to start investing in scale, I would not think of doing that without finding experts in that area that knew that market extremely well. It's very risky just to buy off the internet without knowing the source of the provider, without really doing research or getting third-party impartial input. Don't do that. Make sure you go with a long, positive track record source, and do your homework. Find out what's going on in that particular market. Obviously, if the market hasn't taken off yet, you're going back up, you'll probably get a better purchase price. But if you've missed the bottom, then you've probably significantly reduced your risk of losing equity. And I think that's even more important these days, is to protect what you have than it is and how much it's going to go up. And what you want to do is make sure that whatever you purchase is going to cash flow now, not hopefully sometime in the future. And you've got to be honest with yourself, not that it will break even or cash flow under ideal conditions, but after you consider some maintenance costs, some turnover costs, some vacancy, all of those things, make sure that you don't buy something that's not cash flowing right now. So I think in many areas this is an excellent time to buy. I think it's probably the best time to buy for the rest of most of our lifetimes. Interest rates are very low, and it's a very good timing. But you have to, again, be very careful about what submarket that you're in. Go do your research and make sure you pick a submarket that is strong, and that it's certainly that the numbers indicate that you're going to get cash flow from it. Not just because the market is going up. It's got to have a 1% or greater rent ratio, and we've talked about that before, but that's the most important thing. So this is AM 1220 KDOW. We will be back in a couple of minutes with some more great listener questions.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360. We are answering great questions from our listeners today, and we will just jump back in and continue. Lou Wynn writes in and says, what if I don't have good credit or money to invest, but I'm convinced that real estate is a great thing to invest in, especially now? Well, the answer is that if you listen to some of these gurus who are wanting to sell boot camps and books and tapes and so forth, they will try to convince you that you don't need any money to buy real estate and that it's easy, and all you have to do is go find subject to properties and so forth. Well, I don't think most of those mentors are being untrue, but I think what they don't share with folks is that it takes a lot of work to find a deal anyway, especially in this market, much less one with no money down. So there are a couple of ways to do it. To earn money in real estate. One would be to go find an equity partner. Go find someone who doesn't want to be involved actively, but has money, has good credit, and team up with them. Say, okay, if you can I equity share with you? If I go find the property and I manage it or lease it or rehab it and take care of all that, and you put up the money, can you give me a share of the equity when we sell it and a share of the income as it goes along? So that's one way. And another approach would be to, again, you need an equity partner to start with, and you can certainly flip properties. And flipping, I think everyone knows that term now, but it's buying a property that's distressed and fixing it up and reselling it for hopefully a profit. And the problem is, if you don't have experience with that now, it is very, very difficult to find properties with a margin. We have a part of our business does flip some homes in California to owner occupants. We provide investment properties out of Dallas-Fort Worth to investors. We've done over 300 of those out of Dallas-Fort Worth. But I'll tell you, whether it's there or here, it's very hard to find properties. The past year, just to give you an idea, for every property that we win we have averaged about 40 offers to find that one property. So I get folks that come to me once in a while and say, Tom, I'd like to, I'm trying to buy something. I've been making offers and I don't understand what I'm doing wrong. I can't win anything. And I ask them, well, how many offers have you put out? And they'll say, well, we've put out 3. And I'm reluctant to tell them that I average 40 because I don't want to discourage them, but I also want them to, be realistic at what's going on out there. Even on the courthouse steps, a lot of people who are buying the few properties that are available are often overpaying because they're feeling desperate for product. And of course, whenever someone feels desperate, you're then putting yourself at risk. So be very, very careful about that. I would get an equity partner and go take one of those 2 approaches, but just be aware that if you're doing investing for short-term gains, it's pretty difficult in that world right now. And if it's not too difficult, you may be in an area you don't want to be investing in, such as something outside the areas in this valley which are still struggling, or more distant places like Detroit or Las Vegas or so forth. Just again, be very careful. Go get yourself an equity partner, and that'll allow you to get started. This is AM 1220 KDOW. This is Tom Wilson, your host for the Wednesday edition of About Real Estate Investing. And after a couple minutes, we'll be right back with you.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back, Real Estate 360. We're answering listener questions today, and we will move on to a question from John Wilkes that is similar to the one we just answered, but he says, how much money do I need to start? Well, I'm going to assume from that it means long-term hold. And I would say in most cities in the country where you can really honestly cash flow positively, a typical price of a home is $100,000, $120,000. And a good quality home. To get a loan, which most people want to or need to do, you will need to put down 20 or 25%, usually 20% up to 4 properties, and then 5 to 10 properties, you will need to put down 25%. Even with that, with today's current interest rates, that can be a pretty good payment amount compared to what it has been in the past. And you will need about 2 to 3% closing cost for your lender and title company and survey and other things, depending upon which county or which state you're in, different fees. And you also need another 2 to 3% of money for the prepaid insurance and prepaid taxes, which the lender will require. So that adds up to about 5 or 6% on top of 20% or 25%. So a good rule of thumb I tell people is that about $100,000 will get you 3 nice quality properties in a good metro that will cash flow. What is the best area to buy in? Well, we could do a whole show on that one, but I'll give a brief answer to that. This is from Jody Baldwin. And Jody, the first answer will be that I'll give you is that you need to find an area that has a rent ratio after all expenses are paid to get the property renting, and it doesn't count, until that first rent check is in the bank. At that point, then you add up all your expenses from the time you bought the property, that you did your rehab and paid the utilities and rehab surprises and taxes and insurance and property management and lease-up fee and advertising and so forth. When all of that's added up, then it counts as to what your total cost is. So when you take that total cost and you divide that into the rent that you're going to get, let's say that cost was, let's say it was $85,000 you bought the property for. By the time you got all your expenses, it was $100,000, and it rents for $1,000. Then that's 1% rent ratio. So that's kind of the break-even point where you want to be. That's the minimum you want to be in order to have positive cash flow with 20% down. So you find an area that has a good rent ratio. You want to find an area that has inward migration of people, and you can certainly look at those stats on U.S. Census Bureau, and they update frequently. Go straight to uscensusbureau.gov, and you will find those stats for the particular area that you're interested in. They update them frequently. You aren't just stuck with the last census data. They keep that updated. And you want to find out where people are going. You want to be in a city that says growing population, and what generally drives the population, of course, is jobs. So you want an area that has more than one large company. A place like Dallas-Fort Worth that I'm most familiar with in investing has 25 Fortune 500 companies, has the number 2 in the nation, next to only New York, and the amount of revenue generated by Fortune 500 companies. You want a broad-based economy. One of the negatives, I must say, about an area like Silicon Valley that I've lived in for 43 years, as much as I love it, it's very exciting, and it's been very good to me. I say it has Silicon Valley-itis a bit because it is mostly high-tech, and yes, we're a lot broader based than we used to be. When I arrived in '69 to work for Fairchild, it was primarily semiconductor and some defense contractors, and it's certainly a lot broader based now with biotech and internet and software and computer and so forth. But it is still technology, so it often follows, real estate values often follow the NASDAQ to some degree. So a place like Dallas-Fort Worth that has an economy, sectors that almost exactly mirror that of the U.S., and so that if one sector economically goes down and others do not, you've got more stability in your region and your employment. So you want to have net jobs going up. You want to have a population that is increasing and is projected to increase. A number of studies have shown that there's 3 cities that are most likely to be the top emerging markets in the next 20 years, and that's Calgary in Canada, that is Houston, and Dallas-Fort Worth. And I'm not familiar with Calgary and how those rent ratios are, but Dallas-Fort Worth and Houston, both of those areas get good 1% or greater rent ratios and have net job increases. Now, another city that's getting net job increases is Boston. That's a pretty hot area. And Silicon Valley is doing reasonably well. But it's very hard to get the 1% ratio in those. So you have to have both of those factors in order for it to be good. You have to have the 1% ratio and growth. So you need to find places that add all of these up, and those are areas that are worth considering for investing. So you're listening to AM 1220 KDOW. This is Tom Wilson, your host for the Wednesday edition, and we will be back in a couple of minutes here after a couple of announcements and answer some more of our listener questions for the day.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360. This is Tom Wilson, your host for the Wednesday edition of Real Estate 360, where we're answering today questions from our listeners. So we have time for about one more. And that is from, let's see here, Bob Hertz says, what are the challenges of buying a property outside your own state or area? Well, first of all, I will say that it's not as great as some people feel because it's not a whole lot different than buying, say, securities or stock. You don't need to buy stock in a company that's in your neighborhood just because you'd like to drive over there and kick the brick and mortar and try to interview the management. But so same thing with real estate. I think you buy in the area that has the best return. But again, because it's outside your area, you certainly want to have it very well managed. You want to have a team that you buy it from that you have a good calibration on, that has good references, that has a good track record. You want to buy from a source where you're getting it directly. They're not just a referral source to some other region, some other turnkey provider or agent. And be careful that to go to a region and just ask for any agent and walk in and say, have you had any experience in real estate investing? Because they may say yes, and that meant they sold a duplex last year. And that's you want professionals that have a lot more experience in that. So get yourself a team that understands the situation, that understands that region exceedingly well, that has a very good track record. And like I said before, if I went to another city to start investing, even though I have experience of buying and selling over 2,000 units of real estate, I wouldn't dream of going to another area without finding the experts for that particular region. So that's our questions from our listeners for today. My top tip of the day is if you want to find out which direction a neighborhood or real estate values are going, one of the key factors to look at is how much negative equity is in that neighborhood. So if you go take a look at how many houses are upside down and by how much, that will give you a pretty good feel as to whether or not they've reached bottom, if they're going down farther, if they're going to be stable, they're going to be going back up. Of course, we have intervention by the government with interest rates and the regulation of the rate of release of properties and inventory. So because of that, we've got factors in there that affect what would otherwise be a free market and make it a little bit easier to predict. But if you take a look at what the negative equity is in one neighborhood versus another, they'll certainly give you one indication of what the strengths are. And why is that? Because until all that negative equity, until all that debt, I should say, is cleared out, those homes really are still underwater, and they're going to affect the overall general neighborhood. Fortunately, here in the Bay Area, I think our negative equity has reduced, but quite a bit, and given us upward strength. But we're not totally out of the water yet, so you still got to be careful where you're buying. So please join us next week when we have Richard Crouch with us, who is a very experienced real estate investor. He's also with financial services professional with Transamerica Financial Group, veteran Silicon Valley entrepreneur who specializes in financial services, as well as a lot of experience as a top producer in Silicon Valley. So he will give us some good insights as where things are going and what's going on here in the Bay Area. So make sure you're with us. We've got, again, go to TomWilsonProperties.com, and you can let us know what your questions are. And we look forward to having you back with us next week.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. AM 1220 KDOW.